All right, should you pay your mortgage off sooner? If you're a first-time home buyer looking between a 30 and a 15-year mortgage, and you're wondering with all these different types of information or videos that if you should get the 30-year because then you can invest the difference, or get the 15-year because being debt-free is the best way to go about it, then this video might be just the one for you if you're still struggling whether you should pay off your home sooner or you should get into a 15-year rather than the traditional 30-year. Stay tuned. All right, so right off the bat, if you're seriously considering a 15-year mortgage, then you're probably someone that makes over $100,000 combined income, because in California, the average house price is $700,000, and you need at least an income of over $100,000 to be able to afford that home and be under that 50% debt to income ratio. That being said, if you're considering that 15-year and you can afford it being under that 50% debt to income ratio, then going with a 15-year mortgage is probably going to be your best way to go about it. Why? Because you're going to get a lower interest rate, right?
Alrighty then.
Lower interest rate. And if you can afford it, why not? Paying off your home sooner is a great way, just mentally to live your life right, no more debt. So right off the bat, the 15-year mortgage is going to get you that lower interest rate and the peace of mind of having no debt. So now if you're thinking about a 30-year mortgage, the most known reasons why people get a 30-year mortgage are a couple reasons, and let's go over them really quickly. I think the number one is flexibility, because things happen, another recession or a divorce, anything can happen. Being able to not be obligated to pay a higher payment and be way below that 50% debt to income can definitely help you if those things happen where your income is reduced. And second, when going into a 30-year compared to a 15-year, we went over the fact that if you're someone that's seriously considering a 15-year, then you make over $100,000. Like we said earlier, the average income here in California is around $84,000 household. So you can't really afford a 15-year if you make $84,000, right? But if you go for a 30-year, then that gives you much more access to becoming a homeowner. I think that's the second biggest reason why people go into a 30-year, or why you would want a 30-year, is because you have the access to become a homeowner and start building equity. All right, so aside from becoming a homeowner and building equity faster rather than waiting and renting and losing out on equity, it's going to be, if you go into a 30-year, you're going to be able to invest the difference. And in the example that I'll show for you guys right now, it's about $11.90, the difference between a 15 and a 30.
Right, so we'll go over quickly how I got the $11.90, what that would look like if you go into a 30-year, if you make an extra payment, and if you invest, how much you're expected to make, and also how much you're going to be paying in interest, the differences between a 15 and a 30-year. Let's look at a couple examples. So the first thing is here on bankrate.com. These are the general interest rates, not specific. They do vary when it comes to credit. These are for a 30-year 6.52 if you see here in the blue, and for a 15-year fixed it's going to be a 5.91 in the green. From bankrate.com, once again, it does vary from lender to lender, and if you buy down the rates, right? So let's look at our first example here, based off of a $700,000 loan on a 10% down payment and a 6.52% interest rate. This is going to be included taxes and insurance. Here is for the local here in Orange County. We've already calculated this. Looking at the $700,000 loan with that 6.52%, right, where we got it here, the very general interest rates, right, mortgage interest rates, it's going to be a payment of $51.60 over 30 years. This is the total investment that you'll be making if you make that payment every month for the next 30 years. And then let's ignore this 20% down. Let's go look over here at the blue. With a 15-year mortgage, like I said earlier in the video, you'll get a favorable interest rate because you're going to be paying it back much sooner. Your payment does jump up to a $63.50, and you'll be saving around $500,000 if you're able to make this payment for 15 years. And where I got that interest rate, that 5.91, right back over here in the green for a 15-year, 5.91. So this is how it looks for these two different payments, a 30-year and a 15-year. Now quickly, where I got the differences between these two, right? I've already calculated here 63.50 for a 15, and then for a 30-year 51.60. The difference is 11.90. Now I want to go over the extra payment and as well as what you can do with this, the leftover after you make that extra payment, how much you'll save in interest and how much earlier you can pay off your home, and as well as what you can make if you invest that into an IRA or a 401k. Let's go quickly over the next example of making that extra payment. So based off of the same example, $700,000 loan, 10% down payment, and if you were to just minus 650 off of that 1190 for that 30-year mortgage, right, the difference between a 15 and a 30, you're left with 540 that we'll use to invest. Let's put that to the side now. So that's 650 for a 30-year mortgage. The difference, right? If you make that extra payment every month, you'll actually pay off your home 9 years and 6 months sooner, and you'll be saving around $290,000 if you make that extra payment and go with the 30-year instead. Now let's go over the next thing. Based off of the average return of the stock market, right? You're expected to make around 7 to 10%. Some years less, some year more, some year more. I'm not a financial advisor, but this is based off of Google and some pretty credible websites, right? You can look it up yourself. I'm not a financial advisor, but you can get this off of credible sources. So 7 to 10%. Let's be conservative and let's go over to the calculator. This is basically just any generic calculator that I put in here, and where I got that 540 here is the leftover of the 1190 going with a 30-year mortgage, right? You'll be left with 1190, and then we minus the 650 because this is the extra payment. You'll be left over with 540. The max contribution for 2022, I think it was 6,000. This is the automatic input, but I believe for 2023 they're going to be raising it to 6,500, but double check yourself. But for this example, we're going to be starting out with 540, which is the difference, right? Then if you start at 25 years old, which is pretty typical for people who get out of college and they want to get a home and they're thinking, should I do a 30 or a 15? Let's just say you start at 25, and this is long term, right? And you see the numbers here for the next 35 or 40 years. If you were to continue to make that payment and start at 25, then with that expected rate of return, a very conservative rate of return is 7%, right? You can expect more or less. But over the next 40 years or so, depending on when you retire, you're expected to make around this big number here. So that's pretty much what I wanted to go over to today. If you were to go with a 30-year mortgage rather than a conventional 15-year, sure, you're going to save that difference in slightly lower interest rate, but you're going to be missing out on this amount if you start investing now. And then if you really wanted to pay off your home, you can, and you have the flexibility to do so even when you're in a 30-year mortgage. So that's it. Let's get back to the video.
All right, so these are the pros to 15 and a 30. The 15 is going to be the peace of mind of getting out of debt sooner and getting that lower interest rate, right? And a 30 year, the pros are flexibility, becoming a homeowner because the barrier to entry is much, much lower because most people can afford a 30 year. And then you're building equity, right? Because you're not going to be renting anymore. And also investing the difference from a 15 to a 30 and getting into an IRA, 401k, or mutual funds. Let's go over the cons of the 15 and a 30. So if there's a con to getting a 15-year mortgage and you can afford a 15-year being under that 50% debt to income, then the biggest one would be the less flexibility because you're going to be obligated to pay that much higher amount. And if something happens, you're either going to have to sell the home, right? Or refinance into a 30-year or longer mortgage so you could have lower monthly payments that comes with a cost when you refinance. All right, so the second con to getting a 15-year mortgage is you're going to be on a tighter budget, meaning if you're trying to save up 6 months of expenses for a rainy day, or if you're trying to save up for retirement accounts or for the kids' college, you're not going to be able to because of that less flexibility and that obligation to that much higher payment. All right, so those are the biggest cons for a 15-year. Now for a 30-year traditional mortgage, the two biggest cons that I know of are that you're going to have to pay a higher interest rate because it's a much longer term, and you're going to be paying more interest if you pay for the 30 years. Now you can avoid the more interest and the slightly higher interest rate if you do a buy down of the rate. That's much more common in a buyer's market like now. And you can avoid the more interest if you make a bi-weekly or an extra payment every single month. That'll help you pay down your home much sooner than the 30 years. But at the end of the day, you have the flexibility when it comes to a 30-year as opposed to a 15-year where you don't have that flexibility and you're obligated. Yes, you're saving up front on the interest rate, but you're not you don't have that flexibility that a 30-year has, where you can avoid these two with a buy down and with making extra payments every month. Those are the biggest cons and the pros to getting a 15-year and a 30-year mortgage. If you still have questions, then feel free to reach out. And remember, if you're looking for safety, then going with a 15-year and you're able to pay that off because you can afford it and you make more than the average income here in California, right? Then go with the 15-year because it's much safer. But if you're looking, and you don't make more than that average income and you have to get into a 30-year, then the freedom and the safety is there because you're not obligated to make that 15-year payment.
It's truly awesome.
And you're always, free to make that extra payment to pay the home off sooner. So if you want the freedom and the safety, then get a 30-year because you can invest more when it comes to a 30-year and invest in the difference. And you have that safety, the flexibility of not having to pay that much higher payment. So guys, if you guys found value in this video, feel free to subscribe and follow the journey. I'll see you guys on Tuesday when I do that long run. This channel is all about mindset, mortgage, and fitness. Stay tuned. Follow me on Instagram. Subscribe. Leave a comment what you want to know next. I'll see you guys in the next one on Tuesday. See you guys.